Welcome everyone. Welcome to the KISS Investing weekly review for the week of July 31, 2020. This week was a crazy week, my friends, and let me show you what we're going to talk about today. We're going to review the major indices, both on a weekly basis and a yearly and monthly basis. We're also going to talk about the FAANG stocks, which all reported Thursday night, which was really crazy what happened. And then we're going to take a look at the main market sectors as well as the sectors within the S&P. Also review our anti-bubble positions that are working really well. And finally, I have something new for you guys, which is my trade of the week. I'm going to see if you like this new segment. Please comment below, and if you like it, I will continue to show you cool and innovative trades each week, if that's what you guys want. So without further ado, let's get to it. So here we have what's going on with the indices. Year to date, the NASDAQ, if you remember last week, the NASDAQ was up 19%. We are now up 25% for the year, which is absolutely crazy. And the S&P, which also had a very strong week, is up 1.5% for the year. And the Dow and the Russell are lagging behind, down 7 and 10%. I really don't know why we are up so high. The economy is disintegrating. We had the worst GDP print in the history of humanity, minus 32%. We had a terrible jobless report, and I guess the only game in town is the Fed. That's why we're up so much. On a weekly basis, the market was up, the NASDAQ was up 4% for the week, which is absolutely crazy. Just take a look at this up move. All the indices had a humongous up move. And the S&P almost 2% up, and only the Dow had a negative 0.27% decline, which in this market is probably considered a crash. Of course, we had the Fed coming out and saying that they were going to print money until the end of time, until the dollar is worth nothing. And the market really liked that. The market likes it when the Fed devalues the dollar and destroys the buying power of the American people. And also, FAANG earnings, something we're going to talk a little bit more about the FAANGs, but they had a very weird reaction to earnings, almost schizophrenically. Now, here are the FAANGs. I wanted to show you what the FAANGs did in the month of July. I also included Tesla because Tesla is absolutely crazy too. Tesla was up 33% for the month, just in the month of July. Can you believe that? 33%. We also have Apple up 16% for the month, Google 5%, Facebook 12%, Amazon 14%, as everybody buys everything on Amazon. No, I don't know how the other stores survive if we're all buying everything at Amazon. And Microsoft actually reported the week before last, and it only had a 1% up move. So I guess Microsoft is the ugly duckling. If you were watching the markets last night, after the FAANGs reported, all the FAANGs were up huge. All of them except Google. Google, for the first time ever, recorded a decline on it's the first quarter that Google shows negative growth. But in this market, of course, nothing bad happens, and Google shrugged it off. But Apple blew out its numbers as well as Amazon, and Facebook also had a very strong showing. That famous Facebook boycott of ads, probably we're not going to see it until the next quarter, if it ever comes to fruition. Now, let's take a look at the main sectors. Once again, I'm getting almost tired of repeating the same thing week after week. For the week, silver had another 19% up move. Gold had another 6% up move. Bitcoin 5%, and the euro 2%. Now, why are these indices moving so much? The reason is the Fed is destroying the value of the US dollar. They're devaluing the dollar by printing so much money. And of course, when the dollar goes down, commodities goes up. And also inflation goes up. So this is something the Fed probably is looking in their rear view mirror, and they're looking very, very closely. And I'm sure what they're gonna say is, oh, that's our target. We were targeting 2% inflation. We're very happy to have a 2% inflation. But in the back of their minds, they know that inflation is the biggest tax on the US people, the US taxpayers, because it makes everything more expensive. And they're gonna have no choice but to at least stop printing money or start raising rates. And you know what's gonna happen to the market when that happens. So I'm sure they don't wanna do it right now. Now, let's take a look at what happened to the sectors inside the S&P. Unbelievably, technology was down 1% for the week, even with a humongous showing of the FAANGs. What this is telling us is that all the power and energy in the market is concentrated in those 5 or 6 stocks. That's it. Also, you can see the other sectors. The utilities were very strong for the week, and everything was green except communications and technology. So let's see what happens next week. Next week, the bulls have 2 things to hold their hats on. We're probably going to have a stimulus package coming because, of course, politicians are worried about getting reelected, both parties, Republicans and Democrats. So I'm sure they're going to come up with an agreement this weekend, and we will see the future surge on Sunday night. And if we ever have a down move of less than 0.5%, I'm sure we're going to see more vaccine and therapeutic headlines to stop the market from going down. Now, let's take a look at something interesting. I have for you the anti-bubble positions. You guys know I have been pushing these positions now for a while, for almost 2 months. Gold had a tremendous week, as well as gold miners. Look at those numbers. They're up 17 and 10%. Utilities also was very strong. It's up 8% for the year. And bonds, this is crazy. Everybody thinks bonds have to go down, and they don't go down. They're up 5% for the year. And here's the inflation. The tip, you can fool some people, you can fool the algorithms, you can fool the Robin Hoodies, but the tip, which are the Treasury indexed inflation securities, you cannot fool them. You can see that treasuries, the tips know that inflation is coming, and the prices started to go up substantially. This should have the Fed very, very worried about what's going on. Now, this is something new I want to do for you guys every week. This was a suggestion of one of my closest friends, and I hope you enjoy this segment. Remember to click like and subscribe if you like what you're seeing. And also remember that this is not investment advice or recommendations. Please read the disclaimer, as I am not responsible for any results of your own personal trading. So what is this trade? Well, a lot of friends were calling me this week asking me for, can you come up with a trade that will make me some money on the downside, but will not lose money if we keep going up? And I came up with this very interesting position. What it is a long put vertical, 50 wide on the SPX. You can also do it 5 wide on the spiders. Remember, the spiders are 10% the size of the SPX. And if you want to do it on the ES futures, remember ES futures are half the size of the SPX. So depending on the size of your account, or your risk tolerance, you might want to switch from SPX to ES or to the spiders. So here is the trade. It's a 50 wide long put vertical that I did it from 31.35 to 30.85. Why did I pick these strikes? I picked them because the value of this long put vertical is $10 per spread. And what I'm looking for is to pay a maximum of $40 to buy these 4 spreads. What risk am I taking when buying 4 spreads for $10 each? So $10 in the SPX, each spread is going to cost me $1,000. So 4 of them are going to cost me $4,000. Now, if you did it in the spiders, it would cost you $400. Now, in order for it to be a mathematically correct trade, we have to offset that debit, which is a low probability trade, with the sale of something. And here I decided to sell the 30-20 naked put to finance this spread. So you're going to say, what the hell is this, Tony? What position do you have? Well, here is the position again. We bought the 31.35 4 times. We sold the 30.85 4 times. And we sold the 30-20 put only 1 time. And here in the Tastyworks platform, we can see beautifully what we have. First of all, we can see that we have no upside risk. Why? Because we did this trade for a 60-cent credit. If we go back to my first screen, you can see here that I wanted to do the trade for a credit. Of course, if you want to have a bigger credit, the only thing you have to do is pull the put closer to at the money, and that will give you a bigger credit, but it will also increase the risk if we have a huge down move. And the break even, remember we bought 4 verticals 50 wide each. That means if the market goes down, we're gonna make 200 points of SPX. And we sold to finance the 30-20 put. If we subtract 200 points from 30-20, takes us right to our break even here at 28.20. So anywhere here, we make money. If the market goes up, we'll make $60, which in summary, we won't lose any money. And if the trade ends up here, which is our maximum profit, we would make a profit of $20,000 in the SPX or $2,000 if we decided to do it in the spiders. The computer is showing us a maximum loss of $281,000, which would be the loss of this trade if S&P goes to 0. So I think the chances of S&P going to 0 in the next 48 days that I chose to do this trade. You can do this trade anywhere from 45 to 60 days in duration. Most studies that I follow, the studies made by Tasty Trade, show us that 45 to 60 days are optimum when we do a strategic derivatives trade like the one we have here. Also, we can see that this trade has a probability of profit of 97%. And that means we have 97% chance of not losing money. And we only have an extrinsic of $60. That means that this trade will make us $1 a day only. What we're looking for in this trade is to have the market come down and expire within the 2 strikes that we have here, and hopefully anywhere from 30.85 to 30.20. If the S&P expires in this zone here, we would make the $20,000 profit. Now, you're going to ask me, Tony, what happens if the stock market crashes and we go down hard? What we would do to manage this trade would be to close out the 4 long put verticals and take our $20,000 profit. And if the S&P reaches the price of 30.20, we will roll down and out this put to a further expiration in order to protect us. In a future video, I will make a video just explaining what rolling down and out is. I'm sure many of you guys know how to do it already, but for the ones that don't, I will be explaining this on a further episode of our videos. And that's all for today. I hope you enjoyed this new segment. I wanted to give you guys a short delta trade that had no upside risk. And if you like it, please click like very strongly, hit that button, obliterate, destroy the like button, and please subscribe to my channel. I want to wish you all good luck trading next week. And remember, you gotta risk it to get the biscuit. And have a happy weekend, guys.